Good morning, everyone. Good afternoon, everyone. Good day, everyone. This is MOOC 8, Session 8, Cryptocurrency and Central Banking. Hope everyone's being well and hope you've enjoyed the sessions with Andreas Antonopoulos on the more technical aspects. Over the last part of the course, we're going to go to some less technical, more theoretical aspects. And it's nice to be back with everyone. So I'm going to jump right into questions. If you have any further questions while we're going through, by all means, feed them into the live chat. Andreas Vlahos is here to help, and he will feed them to me. We'll see how far we get to. We'll see how many questions we can answer, and we go from there. I will also mention before I begin that we're very excited about next week. Next week we are running the first decentralized conference, Decentralized 2017, which is the University of Nicosia organized conference on all topics relating to decentralization, cryptocurrency, blockchain, and the broader topic of decentralization itself. It is here in Limassol, in Cyprus, at the city of Limassol, which is a coastal city here in Cyprus, on November 2nd and 3rd. It's been a really great group that is pulling together for this conference. There's 42 speakers from 18 countries. There's several hundred participants. For those of you who might have the chance to do it, there is still barely just enough time to jump into the conference. So if you are interested, let Andreas know. Andreas, you should probably post the link also in the live chat, but we're super excited about that. I look forward to seeing how that's going. It'll probably be the biggest gathering our community around unique blockchain and cryptocurrency has ever had in person. It's certainly going to be the largest gathering we've ever had in person. So I'm also looking forward to meeting a bunch of folks who I only know through these types of sessions in person. So we're pretty excited about that. Great. I'm going to jump into questions. Could central bank cryptocurrencies mimic some aspects of Bitcoin that could help them dial back their status of their national currencies as pure fiat currencies, e.g., enhanced proof of work currency issuance or have fixed supply? They could. Of course, they don't need a cryptocurrency to do that, right? There's nothing preventing a central bank from saying, we have a fixed supply of US dollars, and that supply is X. You know, we used to have that in a somewhat different form with the gold standard, where they referenced an external form of value. The reason most central banks don't do that is most modern central bankers believe it is useful for a central bank to have some ability to manage monetary policy in order to get to good outcomes in the economy. What do I mean specifically by that? And without judging the topic, most central banks think that the ideal setup for an economy is mild inflation, 1 to 2% a year. Deflation is viewed as undesirable, as is high inflation. And the reason high inflation is viewed as undesirable is that it imposes significant transaction costs to the economy. If every month you're worried that the prices of everything are going to change 15%, then you have to be adjusting salaries, rental incomes, et cetera, on an ongoing basis. And it's a very impractical way to run the economy. Now, at inflation at the 1-2% level, which you see kind of credible central banks target, yeah, there is a little bit of deterioration of the purchasing power, but over 1 or 2%, it doesn't impact day-to-day operations. You can plan for a 1 or 2% drop in the value of a currency, and if you want, by the way, choose to invest in other types of assets, stocks, bonds, commodities, etc. If you have a lot of cash on hand and you don't want the purchasing power of your cash to reduce. They think this is generally okay. What they're afraid of is deflation. Just like they're afraid of medium to high inflation, they're afraid of deflation. And it's a little bit counterintuitive at first why someone would be afraid of deflation. Prices are going down. People's money's worth more. And the reason most central banks are afraid of deflation is that it ultimately reduces output in an economy. And the output of the economy is the real wealth that it creates. So in a case, I'll make the example more extreme to kind of match what extreme deflation would look like versus extreme inflation and see what the bad aspects are. If I knew today that the prices of everything would fall tomorrow, I have an incentive to wait and not spend. And that's good for me as an individual because tomorrow I can buy more goods and services, but I'm not the only one who's going to do that. I'm going to do that, and my colleague next to me is going to do that, and everyone at the University of Nicosia is going to do that, and everyone in Nicosia is going to do it, everyone in Cyprus is going to do it. So no one will go buy anything today. If nobody's buying, then there's nobody's selling either. And if I'm running a business and nobody's coming to buy my product and I need to sell in order to have some cash to pay my bills, I'm likely going to drop the price. Well, once I drop the price, it's further confirmation to me, the consumer, that, oh, in fact, prices are dropping. It's silly to purchase now. We should wait until some future point of purchase. So it again suppresses demand. And then that cycle continues. And the net effect of that cycle is that eventually I'm going to think to myself as a business that I have too much staff or too many assets or too much production capacity because I'm not selling anything. So I lay people off. But when I lay people off, these people become even less likely to spend. So that also reduces demand. And this ends up creating a kind of vicious circle where deflation leads to more deflation and ultimately less output. The true wealth of an economy isn't measured by pieces of numbers on pieces of paper, right? They're literally just pieces of paper, or they're ones and zeros of a computer. The true output of the economy, the true wealth of the people, is what goods and services, physical or intangible, the country has available to take advantage of, consume, enjoy. And so what you're aiming for is overall produced wealth, in which case most modern central bankers believe that there is better to have a slight bias to inflation as opposed to a slight bias to deflation, so that there's some incentive to say, well, maybe I should buy my house today because, next year it'll be more expensive, and because it promotes consumption, and consumption promotes production, and that creates jobs, and et cetera, et cetera, et cetera. Now, I say that, in the reality, there has only been a handful of currencies and a handful of central banks over relatively short periods of time that have been able to get that right, decades, not centuries. And a lot of countries and a lot of central banks fall prey to the opposite, that it's easier to print, it's easier to spend, and then inflation gets out of control, and that again has its own negative factors that we've spoken about. But it is clear that, and there's a lot of folks in the cryptocurrency community that only look at the risks of inflation and don't look at the risks of deflation. I accept there are risks of inflation, but there are also risks of deflation. We've gotten to see this now in Greece. Greece effectively has a gold standard right now. The gold standard for Greece is the euro. So Greece, if Greece had the drachma, given its weak economic condition a few years ago, the value of the drachma would fall. And if the value of the drachma fell, the Greek products and services would become more competitive in the world at large, and hopefully you would restore economic growth. Because Greece is tied into the euro, and the euro remains fairly strong because it has strong economies like Germany driving it that are much bigger than Greece, it doesn't get the benefit of this external devaluation. So it instead has to do what is known as internal devaluation. It has to reduce salaries in nominal terms, which is very, very difficult because people's obligations in nominal terms don't reduce at the same time. If your salary goes down, it doesn't mean your mortgage goes down or your car loan goes down or anything. And what has happened in effect, this eventually gets expressed in unemployment. Well, high unemployment is tragic for an economy. High unemployment is the perfect example of output losses. Something like a quarter of the working age population of Greece is unemployed. If you forgot everything you know about currencies, everything you know about monetary policy, and imagined two villages, one with 100 working age people who are all working, and one with 100 working age people who are 25 weren't working, clearly the one with the 100 working is going to produce more goods and services and more wealth over the long run for their village. And so it is a failure ultimately not of the individuals who are unemployed or the businesses who are not employing them, but a failure of monetary and fiscal policy that 25% of the people are unemployed, because obviously it's not that 25% of the people aren't capable or willing to work. These are depression level numbers. There's always going to be a little bit of unemployment in the well-run economy, 2, 3, 4%, because you have transitions, you have people who are having difficulties, you have people between jobs, you have people in the wrong careers, you have people who have a skill mismatch with what is needed at that time. But 25% means a quarter of the population is not contributing to the economy. And this is something that's obviously bad. So I don't think central banks, to come back to the question, necessarily think that having a fixed supply is a positive thing. By the way, if they thought that having a fixed supply was a positive thing, there's nothing stopping them from declaring a fixed supply. So if the Federal Reserve wanted to say there are going to be this, I'm aiming for exactly 2.x trillion of M1, it can do that. Now someone will say, well, yeah, but then they could change their mind. And if they did a fixed supply, proof of work, cryptocurrency, they couldn't change their mind. I don't think that's actually the case. I think they can change their mind in both cases. I think they can change their mind in the case where they say, I have a fixed supply and the supply is this without any proof of work or cryptocurrency. Or I have a fixed supply and it's based on this cryptocurrency. And then later they say, by the way, I'm changing the parameters of cryptocurrency, or I'm also issuing dollars in more conventional ways. I mean, they have sovereign power. They can decide to do that. No one's going to stop them. You may punish them or not punish them in the currency markets, but you certainly can't say there's anything a country that can do that is binding forever. And more or less all binding forever examples of money supply at the national level have ultimately failed over the long run. The long run might be centuries, not decades, but they fail. They fail when they're pegged to a gold standard. They fail when they're pegged to a silver standard. They fail when they've been pegged to other currencies, because eventually some confluence of events happens where the peg doesn't make sense. And when reality meets the peg usually disappears. So yes, they could do this. No, I don't think they will do this, or they don't need cryptocurrency to do this. Now, there was a follow-up question to this question, which says, would central banks need to treat central bank-based cryptocurrencies as a subset of its currency? Could this provide even more stability to their national currency? And I don't think the stability point is relevant. What I think is relevant is if and when a central bank is going to issue a central bank-based cryptocurrency, it will exactly be a subset of its currency. I think for the big countries in particular, they're not going to say, we no longer have US dollars. From here on out, we only have crypto dollars. What they're going to say is, we have 3 trillion of US dollars, but I'm going to now issue 30 billion of crypto US dollars. And so when they're thinking about managing the overall supply of money, this is going to be part of the supply they're managing. So I think that is in fact how they would do it if they were going to have a bank-based cryptocurrency. It's conceivable for some small nations or some specialized nations to come and say, I'm moving it all to crypto. But I don't think that's yet on the table for the big economies. Okay, the next question is, are there any of the functions marked on the table from slide 12 that are marked no for cryptocurrencies in terms of what functions they perform that might in the future not be marked as no in the foreseeable future? A complicated and difficult question. When we made this table, we made it using in mind Bitcoin really as the reference cryptocurrency, because you've got to pick something to compare it to. And, when we first made this table, it really was primarily Bitcoin. Now, we're saying Bitcoin is mildly inflationary and then becomes less so over time. Obviously, there have been a variety of coins launched with different monetary policies, and some that have been launched attempting to maintain. So I'm going to the second item on the list, exchange rate policy. There are some that have been launched that are going to attempt to implement a peg, a stable rate, an exchange rate policy. A coin that does that is going to immediately pick up in its list of issues exchange rate policy, FX interventions, FX reserves. I think that's a bad idea, by the way. I think pegs are difficult. They're just as difficult for cryptocurrencies as they are for any currencies. The only party that can give a 100% credible peg to the US dollar is the US Treasury, the Federal Reserve, because they're the ones who can issue US dollars. So, of course, they're not going to default on US dollars. Anyone else has counterparty risk. Anyone else could theoretically run out of US dollars. So if I said, I am launching Antonis coin, and I am going to peg Antonis coin to the US dollar, you could speculatively attack me and find some way to ultimately break me if enough forces go against me. So there's also items here that I consider to be higher level services that I think will develop in the ecosystem, though not necessarily from the cryptocurrency protocol, right? This is banking and account management services. Okay, obviously we have things like online wallets that are effectively banking and account management services and that are built, for example, for Bitcoin or Litecoin or Ethereum. But that's not the cryptocurrency that's providing it. It's private parties building on top of the cryptocurrency. And so some of these things, so I guess my answer is it depends. I think it depends on the coin. It depends on the policy of the coin. And I think it depends on if you're talking about the cryptocurrency itself or an additional application or service built on top of the cryptocurrencies. Okay. Next question. Cryptocurrencies market capitalization is still a fraction compared to fiat currencies. Central banks, therefore, are not really feeling competition yet, though preliminary steps are already being taken to regulate or denounce the cryptocurrency ecosystem. Can you comment on this? Yes, I can comment on this. This is true. Cryptocurrencies market capitalization are still a fraction compared to the large fiat currencies. However, they've been rising rapidly. So for relative to smaller countries' fiat currency market capitalization, Bitcoin in particular has risen very rapidly versus 2 or 3 years ago. However, relative to the major powers' money supply, which is still measured in the trillions, Bitcoin is, say for argument's sake, 100 billion. Now, it's interesting. It's a much bigger fraction than it was when it was 2 billion. right? So 2 billion, you really would say it's a rounding error. Here, for the major economies, you're getting into single-digit percentages as opposed to tenths of percentages. So it's become a little bit more important. Now, the question is, okay, when people are, hear this thing, central banks are fearing competition, and what are they're regulating or denouncing or what have you. I think one should be thinking about a more sophisticated view of what they're actually concerned about. And I don't think it's fearing competition per se. There are countries that put significant restrictions on cryptocurrency, and many of those countries have relatively closed economies with capital controls. A cryptocurrency like Bitcoin at any meaningful scale is incompatible with currency controls because it will make a mockery of currency controls. So I don't think they, in that case, are restricting it because they fear it's going to take over the central banking role. They fear it will hurt their ability to implement the policy they're trying to implement in their country, for better or for worse, in terms of monetary policy. There's also a set of countries, ones with generally open borders, that have pulled together a bunch of regulations, primarily not for the cryptocurrency itself, but for the on-ramps and off-ramps of cryptocurrency to their national currency. The purpose of these usually is anti-money laundering, anti-tax evasion, and consumer protection related. So they're saying, well, if we need to check out suspicious activity when someone's going in and out of a bank account, if someone's going in and out of an exchange in our country, sending and receiving dollars, we're going to check those activities as well. I think it is an intellectually coherent position. One might argue whether you should have these policies or not, but to the degree you have them, and I think most people believe governments probably should check for money laundering and tax evasion, what have you. If you believe that, then it's kind of hard to say that this should apply to a bank account and a brokerage account, but not to a exchange account for cryptocurrency. What most countries have not done, what most open countries have not done in the open economies, is attack the cryptocurrency itself. Now, there's a third aspect that has to do with the overall market capitalization, which is the cryptocurrency a threat to monetary stability? When people say central banks are worried about cryptocurrency and their market capitalization relative to their fiat, this is what they really are often talking about. And this is where the answers to date have been from the central banks. This is not a threat yet, primarily because it's too small, right? So when you're talking 20, 30, 40, 50 billion spread over the world, so maybe even today at 100 billion, let's say 20% of it, 30% of it's in the United States, it's 20, 30 billion. 20, 30 billion in the United States is the equivalent of one decent-sized company. If the stock value of one decent-sized company collapsed, it would not be a threat to the overall monetary stability of the United States. If, on the other hand, Bitcoin in the United States ended up being worth several $1 trillion and was broadly diversified, and people were using it to a significant degree in the real economy, Bitcoin's ups and downs and could conceivably start having real effects on the economy. And then it's not clear what a central bank will do. It's an odd question to think about, because the conditions that would need to be in place to get to there would have to be a relatively light touch for a long time that allowed a bunch of people to get into this cryptocurrency, and then not clear what happens then. So while I am relaxed, where would I be relaxed or unrelaxed about cryptocurrency's future? In closed economies, I'd be a little bit unrelaxed. In open economies, I'd be relaxed in the short to medium term. And it's an interesting question over the long term, what one does next. So I think that's the question on central banks. Okay, next question. Is Bitcoin's initial intention to be part of the monetary field? I don't think it was the initial intention. I mean, who knows? Many hundreds of people. The kind of most classic thing in this field is someone has an opinion of what Bitcoin should do, and of course says, well, yeah, this is kind of what Satoshi would have wanted, right? They go and it's becoming like, a religious text, his writings, and people find support for their position based on he said this or he said the other or what have you. And then there's even the question of, whether or not that's accurate. There's even a question if that's even a relevant way to look at it. Like, does it matter what Satoshi actually wanted? I think, his initial white paper spoke about micropayments. It was not primarily a treatise about monetary policy. Now, very early, the Bitcoin community did tend to embrace a relative fixed supply monetary policy approach, and that it would be a deflationary asset or an asset that would appreciate. And so this was, that feeling is very much around the community. Is that its initial intention? Not sure. I'm not so clear about that. I would say having a fixed monetary supply, and therefore hopefully a deflationary, in other words, appreciating price, is probably a necessary condition for a successful private digital currency. So it's not a question of if it's a good thing or it's a bad thing. It's a question of the only ones that are going to succeed in this case are the ones that have this characteristic, because you need to kickstart the ecosystem somewhere, and you need to get some liquidity into the ecosystem and some value into the ecosystem so that people bring mining capacity and so on and so on. And one pretty reasonable way to get people to convert US dollars and euros and yen to Bitcoin is if they think that in the future they will have made money by doing this. And so if you said whether or not it's better for managing an economy to have an inflationary currency, a currency that will lose value over time, probably is, it's certainly the wrong strategy for a private currency, because for a private currency, you want people to buy into it. And yeah, the great way to get people to buy into it is to make them think they're going to make money. So it's kind of my view on it. There was a related question that I'm not totally understand. As answer to question 7, it says the core developers can suggest, as everyone can, changes to the monetary policy, but these changes can't be enforced without the consensus of the network. Not totally sure what the question is. I think that's accurate. Like, I could suggest that Bitcoin goes to 100 million Bitcoins and even submit some code for that, but it doesn't necessarily mean that I can force that through without kind of a broader consensus of how that should happen. I'm going to skip out of my prepared questions to one that came in from the chat now that I think is relevant to what we're just discussing. Bitcoins and other digital currencies are not used for buying and selling goods. Instead, they're held for speculation. What can be done to change this? I'm not sure it's separable, the development of a currency and speculation, as it's often called. I mean, there is vastly more speculation in traditional currencies. Several trillion dollars is traded every single day between euro and US dollars. It's generally, nobody thinks to themselves the US dollar is worse off because there's a bunch of traders trading euros with US dollars. In fact, everyone thinks these speculators, who are in fact speculating, right? They're trying to make money on these trades, actually help provide a service to the overall currency by having thinner spreads for trading, because people need to swap in and out of currencies for all types of legitimate purposes. And it actually dampens volatility, and it reduces transaction costs. So arguably, Bitcoin doesn't have too much speculation. Maybe it doesn't have enough. Like if it was more liquid, if there were more capital flows in and out, it might end up being less volatile in the long run, and then people might feel more comfortable using it as a medium of exchange. I am sanguine about that because it doesn't necessarily, because there's a question we've had for a long time in our course. In one of my classes, I spent a lot of time, is Bitcoin a settlement network, or is it kind of a retail medium of exchange? And kind of one argument is that it's both, and one argument is that, well, it's just a settlement network. If it's just a settlement network, then the fact that its price goes up, and therefore you get more mining security as a side effect of the price going up, is not a bad thing. That becomes the settlement layer for everything else to be built on top of, and then someone could either do short-term transactions in a different coin altogether, or in a side chain or channel secured by the underlying network. So no, at some level, it kind of is what it is. There's plenty of other cryptocurrencies that have been optimized for the perceived weaknesses of Bitcoin for transactions. Bigger blocks, faster confirmations, etc., etc. It's not like you've seen a bunch of transaction flows in those currencies either. So the question is there an underlying unmet demand in developed nations for people to buy their coffee with Bitcoin? Probably not, actually. I actually don't think that's what the big idea is here. I think the big idea for Bitcoin in particular is, here's some type of store of value that's decorrelated with the traditional system and kind of unseizable depending on how you store it. That's one idea. Another idea embedded in it that's definitely true, it allows uncensorable transactions. And there's no particular reason why me buying my coffee needs to be an uncensorable transaction. That transaction is usually never censored. And the third idea is that it's kind of an open global settlement network. And maybe the fourth idea is that it's a basis for machine-based transactions and programmable money transactions and permissionless transactions, right? So all of those concepts are interesting, and none of them necessarily entail B2C retail spending, particularly in developed nations where the payment networks are very, very decent. So, and if B2C retail spending in cryptocurrency needs to be an important topic, one would presumably start seeing evidence of it somewhere in some area. So we'll see. It might happen. It might happen on Bitcoin, or it might happen in a different coin, or it might happen on a little side channel on Bitcoin itself, and we'll have to see. But I'm not hung up about it, because the markets talk, and if there appears to be more value for the consumer in holding it or it being a B2B settlement channel than in retail transactions, and I think that's okay. Check these off. Are central banks worried about their future? My guess is no. And not to say that they shouldn't be worried about some parts of their future on how to make sure they use their role to allow innovation in payments and monetary systems. But that's different than me thinking they're actually worried, because my guess is the average central banker is fairly conservative, and the average central banker thinks reasonably highly of their central bank and probably somewhat less highly of a goofy, in their mind, digital, complicated currency that's bouncing around all over the place, and probably doesn't think like this is a threat to their future. And I mean, they're probably right. I don't think any central bankers are likely to lose their jobs because of cryptocurrency. At least in the major economies. Like if you had a central bank under complete collapse, then Bitcoin might be an appealing alternative. But there you're already worried about your future because you're a central bank under complete collapse. Like, Venezuela is a great example, right? Like the currency is in a hyperinflation mode. The monetary and the fiscal system are a complete mess. And certainly if I was a Venezuelan, I'd certainly prefer to hold cryptocurrency than my own national currency. It's not only less volatile, it's volatile in the direction upwards usually, versus my own national currency that's volatile in the direction downward most of the time, or all the time right now. Needless to say, the government goes after miners in Venezuela, and there's probably no practical way. The only way Bitcoin gets into Venezuelans' hands is through mining, because through an exchange, someone would have to be interested in holding bolivars in exchange for Bitcoins, and that's probably a pretty thin market for them. Now, the government has gone against certain miners in Venezuela. On the other hand, people are shipping miners into the country. And I was reading a mining company, and I guess this is called corporate social responsibility in the context of being a cryptocurrency mining production company. There was one mining company that said any orders from Venezuela get immediately bumped up to the top of the shipping list, and they send those out immediately. So even despite everything, mining rigs are showing up in Venezuela. And in a case like that, yeah, it could be a compelling alternative as a national. Someday someone will peg to a cryptocurrency as opposed to their currency, probably because their central bank's kind of under collapse anyway. Right? Like I don't think the Federal Reserve is worried about its future. And I think the Venezuelan central bank probably is worried about its future, but I think they're worried about the future because of how they've been mismanaged, not because of cryptocurrency per se. I'm going to take another one that came from the live chat. Do you think Bitcoin will be difficult to survive in the long term as it has a limited coin issuance? No. I don't see any particular problem with it having a limited coin issuance. There are plenty of Bitcoins out there. They are divisible to the 8th decimal point. If for some reason even that's not enough, one could divide them even further. And if Bitcoin provides something useful for people to do with Bitcoin, then presumably you can buy Bitcoins from people who have them already. And it kind of doesn't matter if you're a new entrant. Let's say you're a new entrant, not because you want to make an investment in Bitcoin. Okay, you're a new entrant because you want Bitcoin for its value proposition. Maybe you want to put $1,000 in an unseizable currency. Maybe you want to send a remittance to the Philippines. Maybe you want to make a politically sensitive purchase. Maybe you need it for your automated drone. Whatever you need it for. Well, you can just as easily buy $1,000 worth of Bitcoin when Bitcoin is $100 a Bitcoin as you can now when it's 5,000 per Bitcoin. In one case, you end up with 10 Bitcoins. In the other case, you end up with 0.2 Bitcoins. But kind of what's the difference? You're still getting $1,000 worth of Bitcoin, which is presumably what you need to do the job you need to do. If you want to send 1,000, I mean, let me take the simplest example. You want to use Bitcoin to send remittances. You want to send $1,000 from Cyprus to the Philippines. In case one, you buy 10 Bitcoins, send them to the Philippines, someone redeems them. In case two, you buy 0.2 Bitcoins, send them to the Philippines, and someone, again, exchanges them out there. What's the difference? No difference whatsoever, if anything. And so then the question is, well, does limiting supply have any other effect that might be negative? I mean, to the degree that demand is there for a Bitcoin, limiting supply probably drives the price up. And that probably increases its utility to some degree because it gives more, it can absorb more transactions. You know, let's say I'm going to use some stylized numbers, right? I'm not saying these are the right numbers, but it kind of doesn't matter. Let's say 10% of the Bitcoin market value is tradable every day in exchanges. And so when the Bitcoin market value was $2 billion, there was a couple hundred million for trading, which means on a daily basis you could get a couple hundred. I mean, depends how often it trades and blah, blah, blah. But that's what's available for you to do transactions of whatever type you want in Bitcoin. If the same figure is held when Bitcoin's 100 billion and 10% is being traded, then, well, 10 billion of transactions can kind of go through. And if it was a trillion, then 100 billion of transactions can go through. So I don't really see any model where the price of Bitcoin going up is bad for the utility of Bitcoin for anything other than if you're betting on the raising or lowering of the price. Okay. Why is consumer knowledge one of the Fed's key areas to focus for Bitcoin regulation if they don't expect Bitcoin adoption rates to increase? I think generally governments consider consumer protection, of which consumer information is a subset, to be a good thing, a good business for the government to be in. There's a long history of consumers being mistreated by financial products of different types, long before Bitcoin, right? So kind of the history of financial regulations tends to be along the lines of someone thinks of something nasty to do to consumers, does this nasty thing to consumers, consumers then feel wronged and aggrieved and complain to the government of why didn't you protect me from this, and then they go pass some regulations to hopefully, though not always, protect them from it. And sometimes it has the opposite effect, sometimes it has the right effect, sometimes no effect at all. But I think they consider this to be one of the businesses that they are in. So this new thing comes up, it's cryptocurrencies, or now it's ICOs, and kind of the logical thing you'd expect a regulator to do is like send messages to people of like, hey, this has these characteristics. It could be risky. Watch for these topics. Check these other topics out. I think that's natural. And it's certainly a big enough field now that any regulator would feel they need to comment on, even if they didn't think there would be growth in the future. And I'm not sure it's their opinion that there won't be growth in the future. It's be a little odd to look at a field that is growing hundreds of percentage points a year and think to yourself, well, we're not going to grow any further. That's unlikely, right? So if my job was financial protection of consumers, I would certainly feel I would need to make a statement about cryptocurrencies and ICOs and so on. Christine Lagarde, former head of the IMF, recently stated that cryptocurrencies must be examined and taken seriously. How might her statements impact the fractional reserve model, new models of financial information, and monetary policy? Very good question. It certainly was an eye-opener for her when she said that. She's certainly raising the topic at the very highest level and saying, hey, you guys do need, you fellow central bankers, you guys should look at this. There's something here. It's not just a goofy thing you can ignore. And, I was kind of excited when I saw her comments because it'll be very interesting to see what someone of her experience in this area would have to say. But there wasn't much beyond that. I mean, they were generically like, this is important and it could be disruptive and things are going to happen. But then there were no kind of details on what that meant. So it's interesting. I've yet to see a central bank come out with a strong position of, here's why this is exciting to us. I can tell you one thing, I mean, it's kind of obvious. It definitely is a pro-globalization system, right? It doesn't naturally limit across national borders. Now, of course, you can limit it and try and limit it just like a great firewall limits the internet in China, and you can, close exchanges like China did and so on. So, I mean, nothing's an absolute so long as we still live in the physical world. But, when you look at ICOs, whatever you think of ICOs in general, or any particular ICO, it's certainly something new in the world that someone says, hey, I have this investment proposition, and post some numbers on the internet, and then people send them valuable coins from every part of the world simultaneously. I mean, that's new, right? That doesn't exist in the world at large. That did not exist in the world at large before then. I mean, of course, you can send wire transfers, but it's a very different feeling. The instantaneousness, the one system everywhere, the lack of intermediary to send the money where you're sending it, it feels different. So, and these are the types of things that if I was a central banker, I'd say, yeah, it's interesting. These are related to the spaces that I'm in, and they're related to some of the functions that I provide. And so what does this mean? And is this something I should be adopting, or is it something that I should be partially adopting, or is it something I don't mind at all? And do I encourage it? Do I discourage it? Do I stay on the sidelines? I suspect this is a discussion that Christine Lagarde has had. I mean, I'd love to pick the brain of someone like that on how she would view these topics. Maybe we will try in a future class to interview her. That would be a very interesting interview. Oh, here's an easy question. Are there any historic examples of, one second, let me check one thing, where a unit of account for a group or community has changed? And the answer is all the time. And we can don't have to look very far. We just need to look at Cyprus. So Cyprus was on the Cyprus pound until 2008, January 1st, 2008, when it was replaced by the euro. And for 3 years before that, it was fixed through the ERM mechanism to the other Eurozone currencies. And before that, it was not. And before 1972, it was pegged to the pound sterling. And before that, in 1879, we'd use the Turkish piastres, and so on and so on. I once saw a presentation on the currencies of Cyprus through the 10,000 years of its history. And it is fair to say there were a lot of them, first of all. It was also interesting which one was the oldest one, the one that lasted the longest. And it was actually the Byzantine currency that was in place for 700 years in Cyprus, which is an amazingly good run. You know, just in my lifetime, it's already kind of changed forms a couple of times, and in my parents' lifetime, definitely 3 times, and all the way back to my oldest grandfather's lifetime, 4 times. So, you know, you would think that the dollar's been around a long time, and it has been around a long time, but the Cyprus used a currency unit for 4 times longer than the dollar's been around. And the euro is a baby. It's barely been around. It's decades, not centuries. So units of account change all the time. And sometimes they change name, sometimes they change policy, sometimes they change both. But it is absolutely the case that most currencies don't split and don't stick around for centuries and centuries. There still also is a very interesting oddity in Cyprus. 3% of Cyprus is part of the United Kingdom. They kept some bases in Cyprus and the villages around them in 1960 when Cyprus was granted independence. Obviously, everyone knows that the United Kingdom uses the pound. Except in Cyprus, the British bases use the euro. So there is part of the UK that uses the euro, because for practical purposes, since the rest of Cyprus uses the euro, they use the euro. And I'm curious if that's going to change at all after Brexit. I mean, it doesn't necessarily have to, because the UK is already not in the euro. But it's one of these nice, interesting historical oddities that there is, in fact, you ask them, well, has the UK adopted the euro? The answer is, of course it hasn't. And then it's kind of asterisks in some certain British territories, part of the UK. But they do, in fact, use the euro. So no, the history of currencies is a history of change. And centuries is a great run for a currency, and many currencies go for decades. And whether you call it a unit of account or a medium of exchange or both, currencies do change. All right, I have probably time for one more question. I still have some questions here. I have some that Andreas looked at. Let me try and pick one that is the closest to the actual topic, which is central banking. They're all not exactly. I'll answer this one. If governments were to create cryptocurrencies, would they be based on the Bitcoin blockchain and use proof of work mechanisms? If so, would they be second layer? I'll answer this backwards. If they are based on the Bitcoin blockchain, they will definitely be second layer. They may or may not be based on the Bitcoin blockchain or the Ethereum blockchain or any other blockchains, in which case they might run their own blockchain, their own proof of work, or use a proof of stake, or use centralized mining, or any other variation. But if they decide to use the Bitcoin blockchain, it has to be second layer, because otherwise they wouldn't be issuing dollars, they'd be issuing Bitcoins. Now, I mean, we've forgotten this now, but there's colored coins, so that wouldn't be second layer. It's another way to represent assets on the Bitcoin blockchain that are not Bitcoins, though those seem to have become less popular now for the concepts of side chains and so on. But whatever the variation that we're talking about is, it's clearly going to be not the Bitcoins themselves, but some way to use the Bitcoin blockchain and its proof of work to represent a different asset at a layer up, whether it's a side chain, a side channel, a colored coin, or so on. So I think we're going to see all variations. Singapore is doing a trial with dollarized, Ethereumized Singapore dollars. I think we'll see people issue on top of existing blockchains and or do new blockchains. And I think it's going to be interesting how that plays out. And where we end up as the preferred solution for national cryptocurrencies. Okay, everyone, this is the end of the session. We've run out of time. Excellent set of questions. We had a full set of questions. We didn't even get to them all. Certainly continue the discussion, please, in the online system and the learning management system. And I hope maybe I'll see some of you in person next week. Hope everything is well, and I will see you guys either in person next week, a few of you, or the rest of you online. Thank you very much, everyone.